Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Ehrman.
Hello, and welcome back to the podcast. Thank you very much for being here. I appreciate it. All right, today we are going to get into debunking some myths about IBC. And so if you are a repeat listener, thanks for coming back. And you are probably hearing this stuff as you talk to people about this. If you are new and you are just learning about the infinite banking concept, and you are like, well, this is too good to be true, then you're going to want to listen because some people are making it sound like it's too good to be true. They're making it sound like it's the solution to absolutely everything and it's super easy and all the things. And so I don't know if I'll get through all the myths in this episode, probably not, because I'm going to add to them. I'm going to keep trying to find them and then we're just going to break them on here. Because it's absolutely crazy the amount of stuff that's going on. As you guys know, I complain about it all the time. All the stuff that's being said that is not true. So let's get started. Number 1, you borrow your money. This is probably the biggest myth. And this is the reason that Dave Ramsey does not like or understand the infinite banking concept. And I find it interesting when I listen to him, he will say, well, why am I paying interest to borrow my money? If I have certain clients that haven't read the book, if a spouse hasn't read the book, or they just can't quite get past the fact that they have to pay interest to still borrow money, they always think they're borrowing their money. So if you are the person that doesn't understand why you have to pay interest to borrow your money, or if you're running across people that are saying this, you're not borrowing your money. So there's this misconception that we are paying interest to the insurance company because we are borrowing and to borrow our money. We are not borrowing our money. We are borrowing the life insurance company's money while they leave our money sitting in our cash value, earning compound interest and dividends. For people that are a little bit older, it's kind of like saying, hey, I have a CD at the bank that's paying me 5%, and I'm going to go to the bank loan officer and I'm going to borrow the bank's money. And they're going to use my CD as collateral. So my CD is continuing to earn the interest while I use the bank's money. It's similar to that because our money never, ever leaves the cash value account. It continues to earn as we use the company's money. So there's a lot of people that will say, and I've probably said it as well, but we just got done with a podcast about scrubbing our language. And I am constantly trying to scrub my language as well and make sure that I am saying things correctly. And so we can't say, oh, we're earning interest on our money while we use our money, because we're not using our money. We're using the insurance company's money. So we earn interest in our money because we basically are leveraging our dollar to use the insurance company's money. The difference between the bank and the insurance company is the dividend. With the insurance company, we're getting paid a dividend because the insurance company made money if we're with a mutual company. Okay, if you are not with a mutual company that pays dividends, this does not apply to you. But if we're with a mutual company, now we're getting paid the dividend and our money is earning compound interest. Where in the bank, if we have a CD, I'm earning interest from the bank. I get to pay taxes on any interest earned, and I don't get the dividend because the banks don't pay dividends. Unless you're maybe with a credit union or something like that, where they do. My little bank does pay dividends, but they're so minor that it doesn't matter. So those are some differences. But the myth is that we are paying interest to borrow our money, and that is not the case. We are paying interest to borrow somebody else's money. I saw this one the other day that your premium that you pay, this is number 2, that the premiums you pay can be tax deducted, just like an IRA, right? They are post-taxed. No. You pay tax on the premium dollars. You're going to earn income. You're going to pay taxes, and then you're going to pay your premium. You do not get to deduct your premium as an expense for a business even. You don't get to deduct it as an expense. It is not like an IRA or a 401k where you get a tax break and then you pay the taxes later. And so I don't hear that one a lot because most people understand that. But I was listening to someone on TikTok the other day and just about died when I heard that. Like, if there is anything that is so wrong, that is probably the biggest issue that I've come across. Number 3, you collect the interest that you pay to the insurance company. And so some people will say, well, I don't care if I have to pay interest because I'm going to get that money back. No, you don't. You do not get the interest that the insurance company is charging you. That goes to the insurance company. You're going to get the interest and the dividends that the cash value is earning, but those are 2 very, very different things. Your policy is doing what your policy does. And on the backside, if you're borrowing against your cash value, then that interest is going to the insurance company. Okay. You are not getting it back. Even if you were to be told, oh, I'm getting that back in the form of a dividend. No, not all of that is coming back to you in the form of a dividend either. Well, can you say, well, I'll get some of that back in the form of a dividend? Well, I don't know if that's even accurate. I would look at that and say, yeah, maybe a little bit, just because of the fact that you paid interest to the company made money, you got a portion back, but it's a very, very small portion. The biggest thing is, like I said in number 1, you're earning uninterrupted compound interest and dividends on that side. So the insurance company is not putting the interest back into cash value. So there's people out there saying, well, you want to do infinite banking because you recover the interest. And no, you don't recover the interest. You can get some of the interest back that if you pay above and beyond what the insurance company is charging you. So let's say the insurance company charges you 5% interest, but you pay back 8. Well, you're going to have that extra 3% that can go back to you, but it's going back to you as premium. It's not going back to your loan repayment. And so that's also another misconception. But all in all, the interest of whatever the insurance company is charging you is not going back into your cash value to build cash value. The interest that the insurance company is giving you is going to them. Number 4, you can use a universal life product. I don't know that I need to go into this anymore. If you are new here and this is the first podcast you're listening to, you might want to go back to my other ones where I just go on long rants about universal life. But universal life products, a indexed universal, a variable universal, a universal life, an adjustable premium paying, anything that does not say whole life should not be used for infinite banking. And those policies shouldn't be sold, in my opinion. And that is my opinion. I have seen 2 decent ones. I just had somebody email me last week or the week before that their spouse passed away and they had a UL product. And as sad as it was to hear that that spouse passed away, I was happy that UL product paid out because he died sooner than expected. That is not, it's basically a UL is a term policy, and there's a whole bunch of fees and charges that go along with those policies. And so they're just crap. Shouldn't have them. And definitely don't be using them for infinite banking. If somebody is telling you to use them for infinite banking, it is most likely somebody that is newer to the industry that has no idea what they're talking about, and they don't have the history behind them as an agent to see these things fall apart. And that's really what I'm finding is there's a lot of young people in this industry, or a lot of young agents, as far as like they've just been introduced to the concept. They're not young in age, but they're young in years of practice. And those people have been told that you can use a universal life product and it just doesn't work. And they've not seen that it doesn't work. And they don't know where else to go for research. Now, if they do know where else to go, then they would most likely quit selling them. But some of them have the arrival syndrome and they think they know it all. Don't use a UL product for infinite banking. And number 5, you don't have to repay your loans. That is a huge myth and it is complete bogus. And so a lot of people will say, well, Nelson Nash, the founder of the concept, Nelson Nash said that it's okay to have policy loans so you have a place for inherited money. If you have a windfall of money, you have a place to put that. Okay, I understand that, and I've gone on rants about this as well, but you do not get to not pay your loan. It is a loan. You do not take a loan from a bank and not repay it. You don't take a loan from friends and not repay it. You don't own or finance a house or land or cattle and not pay that note to that person, right? If you are not paying your policy back, you are a terrible banker and you shouldn't have a policy. At least pay the interest, but any good banker will pay principal and interest. If you have an operating note and all you're going to do is borrow and pay back and borrow and pay back right away, great, pay the interest only just as you would do the bank. But there are people out there that are saying you don't have to pay interest and you don't have to pay principal. That is total bogus. Yes, you should. The insurance company says you don't have to. But if you don't ever pay interest and principal, that policy is going to blow up on you. You can't just let it go. You are given the freedom to decide when you want to pay those things, which is fantastic. But don't abuse that freedom and be a terrible banker. If you're going to be a terrible banker, then just don't buy a policy. The insurance company doesn't love to have all these loans on the books that never get repaid, nor do they like it when people can't pay their premium. They are in the business of mitigating risk, and they need to understand what that risk is. They need to see what's going on. Insurance companies are constantly looking at how long is the business on the books? How soon are people taking loans? They're looking at that stuff. And so when you start to see insurance companies that say, well, I don't even like infinite banking. I don't want anything to do with these policy loans. We're out. It is because there are bad characters out there teaching you that you don't have to repay this stuff, when in fact you do, and you should. Okay. So it is not like, I actually have clients that are like, oh, I thought I had to. They didn't know that they could just pay interest only because they are good bankers. And I don't lead people to believe that this is free money. So if you are going to buy something and you would have paid the bank, you should be paying yourself as well. Now, can you miss a year or something? Absolutely. Can you change your payment terms? Absolutely. You have control of that. But don't think that you can just pay premium, take max loans, and never ever pay anything back the rest of your life. That's BS. Okay, we ran out of time for any more, so I'll keep doing these, but that was 5 myths about the infinite banking concept that we need to set straight. So let me know if you guys hear about something and you have questions on it, or you hear somebody else saying something else than what I say, because I would love to be able to kind of group all of these together and say, let's stop the madness. And the only way we're going to be able to stop the madness and misinformation about infinite banking is if we tell the truth. And so let's get the truth out there. Let's share that. If you've talked to people that don't believe what they're hearing about IBC, then please share my podcast with them. And hopefully we can get them educated on this stuff. But I don't have paid advertising, right? I don't stop any of this for ads because I hate ads and I hate when people interrupt their content with ads. Please just share this. That is the best way to spread the awareness of any of this stuff. So let me know if you have anything, if you have questions, comments, concerns, maryjo@withoutthebank.com, or you can go to themjhotline.com, leave me a message, and then I will get back to you. Thanks, guys. Have a fantastic rest of your day.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.